the businesses really like private credit because it provides, unlike traditional finance and banking, it provides them, really just surety of capital, flexibility.
Welcome to a Wiser Retirement Podcast. Are you curious about private credit? Is it right for you? I'm Casey Smith and joined today with our very own investment manager, the king of data, Andrew Pratt. Hey, Andrew.
Morning, Casey.
Each week we bring you practical advice on retirement investing and planning for your financial future. Don't forget to subscribe to the podcast wherever you're listening. Let's get started.
All right.
So private credit, I think people are like, what is private credit exactly? I think we should back it up to a little higher level. Everyone's heard of private equity. They think this is something super exclusive that only the wealthy get access to. But there's private credit, there's private equity, there's real estate, which kind of lives in both worlds.
Right.
And then you have hedge funds, which people probably don't know the difference between hedge funds and private equity. So let's break that down a second. What is all this word jumble of private investments?
I mean, there's a lot of different structures out there. But essentially, private investing, whether it's private equity or private credit, you're investing in private companies. Private equities typically, you're taking an ownership stake in a company that's for long-term value.
Non-publicly traded.
Yeah, non-publicly traded, and it's more for a long-term value appreciation, and that's either done through restructuring or, a sale from an IPO or an exit. Private credit's a little bit different. It's more about, lending money to non-publicly traded companies, private companies, for a shorter period of time, and you're getting interest payments on that. So those are really the main differences there. And then hedge fund, and so I guess well, backing up to private real estate. Private real estate can actually have both structures. There's, you could be an equity investor or you could be a credit investor, and that's where you're participating in the loan structure, lending out, to private real estate or have an ownership stake in private real estate. Um, but then go into hedge funds. Hedge funds, I would say, is a little bit unique and different animal. Hedge funds, you're typically investing in a manager. There's lots of different strategies. I think the most common strategy is a long short fund, where the manager is trying to, maybe have a market neutral or have zero exposure, market exposure. Where the portfolio is sort of just kind of moving, um, sideways to the market. So it doesn't really fully participate in up markets, but also protects you on the downside. Um, but hedge funds are different. There's no sort of income stream tied to hedge funds. And they're just sort of unique structure there.
Hedge funds have always been strange to me because, like, why would you take millions of dollars to put into a fund that's supposed to do nothing?
Yeah.
When you could just buy short-term treasuries and it hedges equities
Right.
perfectly well.
Yeah.
That's the part I've never understood.
My previous firm, we actually had an internal hedge fund, and that was a common objection and criticism with investors is, there's a lot of investors, especially, in the retirement stage that like yield and income, and, they're invested in this hedge fund product and there's no yield that's being spit off.
It's like
from
buying
it.
commodities.
Right. The main selling point is it was actually a very good fund, but the main selling point is it's very uncorrelated and really helps with diversification benefits in the portfolio. So that's the main selling point.
Yeah.
But that's just really kind of hard thing to kind of communicate to clients or investors.
So today we want to focus on private credit specifically. So let's kind of start diving into what in all the private investments. This is probably the most conservative approach to private investing, right?
Yeah, I would say the most conservative. It is fixed income. You're again, you're investing in loans. It's I'd say it's a little bit, obviously riskier than traditional fixed income, but again, it's the risk profile is very similar. You're getting a yield. The portfolio is getting a yield. Consistent stream of dividends or
Mhm.
coupons payments, and again, it's more conservatively positioned.
So let's talk about yield. So right now, a 10-year treasury yields 4.22%. as of today,
Mhm.
what kind of yield should I expect in a private credit investment?
Yeah, I would say obviously that changes over time with where the Fed funds rate is. But private credit, they're actually the yield is based on the the swap overnight fixed rate, and there's really a spread between and each contract that a manager will make with a business, depends.
Mhm.
It also depends on it depends on the structure of the contract. So, but usually there's a spread between this. It's called SOFR, this SOFR rate, and there's a premium there. So, right now, the manager that we've decided to partner with, the portfolio is yielding around about 2.5 times that. About 10%.
Mhm.
10.5 to 11%. So there should be excess premium for it being a private investment. A little bit of a liquidity there, and then also it's just a little bit riskier, with the type of companies it's investing in.
So when we think about private credit, what is what are, well, we'll start with the positives. Why would we invest in private credit? Because when we do private credit, we are actually pulling a little bit from equities and a
Mhm.
little bit from bonds in the portfolio. So
Right.
it's not a complete bond replacement. We It has some risk to it.
Mhm.
So we take away a little bit from the equity allocation.
Yeah, and so I think benchmarking is key here. And just with any private alternative investment, you really should think about where you taking it from in the portfolio. Private equity, I would say for you'd want at least 4% above like where the SP 500 returns if you're investing in private equity.
Hmm.
Private credit again, we want at least I would say at a minimum 300 or 3%, 300 bips is what I was going to say. Um, but we want to be a little bit more conservative where we're pulling it from, because we just don't want to say it's all coming from fixed income, because
Yeah.
that's just not an apples to apples comparison.
Right.
Um, it's investing in, I almost say sub-investment grade, but it's investing again just in companies that are not like the large cap, the highest quality, but it's they have robust teams doing underwriting and due diligence. So they are vetting all these concerns of these companies. So how we're benchmarking it at Wiser is 70%, a private credit allocation would be coming from traditional fixed income,
Hmm.
and 30%, just again to be conservative, 30% is coming from your equity bucket. And that's, US equities and international equities.
All right. So when their private credit fund's doing its thing, how many? There's lots of different options out there to invest in, but typically, how many holdings does it have? Like, how many companies are you lending
Mhm.
to? What's the company risk?
Yeah, so there's again depends on the manager and the portfolio. I believe the fund we've partnered with, and I guess we'll go and say it, it's Goldman Sachs GS Credit Fund. Um, there's I think 50 underlying investments, and then but it's diversified, and this is the thing with real estate. If you decide to go with private real estate, you're just in that one asset class, and maybe even
Hmm.
one subsector of real estate.
Yeah.
Private credit, they're lending to everyone. That could be real estate, it could be
Mm.
to technology companies.
They spread it out different
Yeah,
amongst different industries.
right. It's very diversified in that regard. So, but right now, yeah, our fund, I think it's about 50 underlying investments or
A-
underlying loans.
And what's the cap size that they normally focus on? So what meaning are these Fortune 500 companies? Probably not. These are probably what.
Yeah, small to mid-size. I think it's around 100 million EBITDA,
Hmm.
around that target threshold. But obviously it can range. But I think the lowest they might go is like 10 to 20 million operating cash flow.
Okay. So small business, but not super
Not
small.
super small. No, not speculative. It's definitely has a track record for sure.
So, do you think private credit has become so popular because of the low interest environment that we had for so long? And and if it's so, do you think it will continue?
Well, so I mean, I would say, private credit's definitely gained a lot of traction lately. I'd say the past 5 years, especially past 5 to 10 years. And the past couple years, especially where interest rates, given to the level that they have risen, I would say that should be a headwind to private credit, because there's um You know, as you said, you can buy a 10-year treasury around 4%. That's pretty good.
Mhm.
But so no, that hasn't caused private credit to lose steam by any regard, because again, they are getting that you know premium to that spread. So
Yeah. So
so
if just rates were to keep rising, or inflation continues to increase, then
mhm.
you would hope that your private credit would just keep having that 3% spread, meaning that it would be 3% higher than the standard.
Yeah, and that was one risk, I was concerned with is, we are the Fed hasn't cut rates in a while now, but it's presumed that they will cut eventually.
Mhm.
What is that? How's that going to impact the spread? Because these are floating rate loans. Again, the contract, the negotiated terms are different, but for the most part, they're adjusting every couple months, or even maybe even less than that. So how will that impact the portfolio? And going back to kind of the benefits, the businesses really like private credit because it provides, unlike traditional finance and banking, it provides them really just surety of capital, flexibility, the speed. There's so many regulations with banks, and just kind of uh, the ability. I think maybe in the new administration they might try to loosen some of these regulations, but it's really hard for these businesses to get capital when they need it.
Mhm.
And a lot of times these investment opportunities are very quick. They
Yeah.
need someone that they can partner with. Um, that again can be very nimble, and they like this bespoke nature of these contracts, very custom. And then also with these asset managers that are doing private credit, unlike a bank that does a broadly syndicated loan, they can sometimes work these like just say they got in trouble,
Mhm.
the manager can partner with these companies and say, hey, well, you missed a covenant, you tripped a covenant on your contract. We're going to take over ownership and help work this thing out. Whereas if you're with partner with a bank, they might just go ahead and default and send you to bankruptcy court. So that's one positive, and that's why a lot of these
Mhm.
businesses like private credit, because the managers are willing to work with them, if they do get in a dire situation.
Are you curious why annuities keep coming up as a potential investment option? People are often told that annuities can effectively mitigate investment risks and help secure their financial future. However, annuities often benefit the salesperson and might not be the best choice for you as a consumer. To learn more about the various types of annuities, the negatives of owning them, and better investment alternatives, we have a free ebook on our website just for you. To download our ebook, Buyer Beware, Why Do They Keep Trying to Sell You That Annuity? Simply click the link in the episode notes or visit wiserinvestor.com/guides. Now let's get back to the episode.
So it's a good hedge for inflation because if rates are going up, these rates would be going up as well. It the good portfolio diversifier is what I'm hearing from you, and obviously a higher yield,
Mm.
which is what everyone's looking for when you have your own cost increasing. But with everything comes risk. So let's talk about the first thing that comes to my mind when you think private anything is liquidity. Like
Right.
how long does your money get locked up?
Yeah, and again, it all depends, but there are a lot of they call it evergreen structures, which is just a structure that's not permanently closed. So there's a lot of these evergreen structures out there, and this is something that I think really makes sense in the private credit space, because it's usually there's like an initial lockup, maybe like 1 year.
Mhm,
You could redeem your investment if necessary, but there might be like a slight discount. I think Goldman's fund, it's like a 98% discount if you redeem in less than 1 year. But typically it's quarterly liquidity,
mhm,
and there's monthly investment subscription process. So yes, there's reduced liquidity, like typical ETF mutual fund. But I would also kind of argue that this is a positive in a sense. I mean, not from a liquidity perspective, but from a return standpoint, because that's one of the with private investing, that's one of the positive attributes is this illiquidity premium, is because just say in recent weeks we've had this huge drawdown in the market. Um, a lot of these, just say mutual fund managers, have had to sell assets at in opportune times because they had to
Right.
raise cash for redemptions. This liquidity, illiquidity provides a little bit of a buffer, to where the managers don't have to sell assets. They can sort of manage this. If there are a flood of redemption requests, they can kind of manage that process better, where they don't have to, be forced to liquidate
Right.
these assets. So, but yes, reduce liquidity. That's something that investors definitely need to be aware of and need to plan for if they're going to invest in privates. Also, I'm sure it's widely known private investments come with higher fees. There's the typical management fee.
Mhm.
Everybody's heard the term probably 2 and 20. That's like a standard hedge fund fee, but private
Yeah.
credit, it's a little bit better. I believe our funds at like 1 and a quarter. There's a 12%, um, you know, preferred return fee or incentive fee that where they share in the profit. So there's usually a profit fee, but these are all kind of standard terms in the industry.
Do you
But
still get that net 10 to 11% yield after those
yeah,
fees?
yeah. So the total return of the portfolio, it's primarily all yield,
Okay.
and that's all net. So yeah, so those are net
Net
numbers,
numbers. Okay.
and that's obviously very important.
Right.
And they have, and one thing I'll say is, with those performance fees, there's usually like a hurdle rate, and that's like a minimum return for investors. So you know, commonly it's like a hurdle rate for private credits about 5%. So there's at least guaranteeing, hey, at a minimum, you're gonna, I shouldn't say guarantee, but we're not gonna start taking a profit, incentive fee until you guys at least get 5%.
Yeah.
So at least there's that kind of buffer there. But moving on to other risks, there's limited portfolio transparency. Unlike investing in S&P
You
500,
don't know exactly what's in it.
yeah, you don't know. I mean, they produce monthly fact sheets, and they do a good job giving some transparency, but you don't know exactly. You can't, and they have case studies on different loans that they make, but you don't know exactly what's in the portfolio. It's usually
Yeah.
lagged reporting, obviously because of the valuations aren't as liquid, and it takes time to work with the auditor to to get a true valuation. So there's
Mhm.
lag valuations, and then also use of leverage. Unlike investing in just public equities, there's leverage to these funds that they can use. I would say private credits a little
I,
bit.
I would say that's one of my biggest
Yeah.
fears is you put in $1 and that dollar becomes $2. 100% leverage would be horrible,
Mhm.
because if it all falls apart, you lose everything. In the Goldman Sachs fund, there is some leverage, but not that much
Yeah,
actually.
and the structure that we're investing in is it's a BDC, so there are caps on like leverage. I think the maximum cap is 2%. Um,
Only 2% can
yeah,
be levered.
is
Oh
well
wow.
two like I guess two times.
Oh,
Sorry, two times
2x. Oh,
2x.
okay,
Yeah.
okay.
But most funds won't go. The max they'll go is 1.5 times,
Yeah.
and I believe the Goldman Fund is around 50%, max. And
Okay.
and they did. I was kind of question them, just like, would you guys dial up the leverage a little bit if yields were to come down, just to kind of,
Mhm.
I hate to say juice the return, but just kind of get that return back up. And they're like, yeah, we would look to do that maybe a little bit if we had to, but they're very averse. Again, this fund is more conservative than other private credit funds, and they're really against using leverage unless they
And, and,
unless they need
and
to.
I just talk to our listeners. The reason why we're talking about this one fund is just we've searched the world, our world,
Mhm.
and what was offered to us. And this is really we look at a lot of crappy stuff, honestly. And this is one that kind of filtered to the top as like, okay, this is a conservative fund, has a high yield. They're not gonna do
Mhm.
2x your money
Yeah.
to leverage. Seems to be a more conservative approach. Had a long track record, and just for the record, we have access to everything at Goldman Sachs. So anything a Goldman Sachs advisor can provide, we can provide through our relationship with them and Charles Schwab. And it's probably a good point, time to enter this in as well. These are type of investments we deploy with people with assets greater than $5 million. So
Right.
liquid assets at our firm greater than $5 million. And the reason why we do that is for all the cons
Mhm.
that we're just explaining
Yeah.
is illiquid investment, even though you can get out quarterly, they'll only liquidate 5% of the fund's net asset value. So if
Mhm.
there's a mad dash to the door, you may not be able to get in that
Right.
quarter. We wanted to be focused on the longer term. There is some leverage, which means there is some risk, right? And there's also manager risk. What if this manager just picks 50 really bad companies and they all
Right.
default for whatever reason?
Mhm.
Then your money can go to zero.
Yeah.
Where we have a lot less issues with that with U.S. Treasuries and more traditional approaches that we
Mhm.
use in a normal portfolio, right?
Yeah, I would say, I mean, there's a few reasons why I really like partner with Goldman. Obviously, they have a established team. This fund is fairly new, but they've had different type structures of this version of the fund
Right.
for over 8 years, and the team's been together, I think, almost 20 years. And so, obviously, Goldman's established as an asset manager, but they've also have a very experienced private credit team as well. And I think they're uh, historical default rate across all their uh, private credit type funds is around like point zero 0.05 or 0.5%. So it's very low.
Mm-hmm.
Not to say like defaults could maybe tick up if we do enter into a contractionary period, but still overall the manager's done very well. They have again, established team. Their investor base is very sticky. It's institutional investors. It's RIAs. We like that. So those are the main reasons. And the portfolio again is more conservative versus other private credit funds. It's 98% senior secured loans.
Mm-hmm.
Some other funds go a little bit down the credit stack and they'll invest in mezzanine debt or subordinated debt. And we didn't like that. We wanted something that is a more conservative position in the credit stack.
So and that's a good segue actually. So considerations before investing in any product like this. First of all, I would stay away from the ones that you see on your Facebook feed and your Instagram feed.
Yes.
Or like crowdsourcing. They do not have the protections in place.
Mhm.
Meaning, if you lose all your money in that, there's not a whole lot you can do
Right.
in that scenario, and you really don't have a good way of vetting them other than through their own advertisement, which is going to be very biased.
Right.
So those are not the best places to be
And
investing
and their team
investing money.
is,
But
yeah, and their team is probably, I'm sure there's some qualified people there, but it's not a deep bench. They probably don't have a ton of experience, and it's probably very concentrated in the type of investments that they are making.
yeah, we see that too. These smaller shops, you have all the real estate in one zip code or one state,
Right.
where a more multinational approach. If there's a hurricane in Florida, well, they also had California assets, they had
Mhm.
Montana assets, right? So it diversifies the risk more. But what are some of the key considerations? You've touched on most of these, but what are the key considerations before you should be investing in this?
Yeah, I think again, manager selection is paramount. You want to partner with a team that has a deep underwriting bench. I can't remember. I think it's 4% of all the loans that Goldman's team looks at
Mm-hmm.
will actually make it to the portfolio. And they look at, I think it was like maybe 700 loans. Uh, maybe it was 2023. They looked at 700 loans. 4% of those ended up making it into the portfolio. So they look at a lot. I mean, these managers are inundated with opportunities, and just being able to adequately sort of sift through those opportunities and identify the best ones and properly vet them. I asked Goldman about Trump's tariffs and does that really impact and the new administration policies, and they're like, for the most part, no, they're insulated from that, and they also take that into consideration in their underwriting. So
Mm-hmm.
they do account for that kind of stuff, economic macroeconomic risk.
So that goes back to some of the objectives and criticisms. So would lower rates adversely impact the portfolio? So if the rates went the opposite direction?
Yeah, yeah, we talked about it a little bit. So lower rates, yeah, the yield might compress a little bit, but for the most part, no, that actually might be a good thing. That means that the credit quality, could be getting better for these underlying companies as well. So that could be a positive, but yield might compress a little bit.
Um, we talked about tariffs. That the only way it would affect a business is if that business was affected by tariffs and then couldn't pay their note.
Right.
That
Exactly.
in this case. Um, What about, there's so many private credit opportunities. Is this space overcrowded?
Yeah, again, that comes back to being manager selections paramount. You want to partner with someone that has a good team and track record. But no, I would say right now private credit, the market capitalization is around 2 trillion. For a frame of reference, private equity is around 11 trillion, and I think like the high yield space is about 2 trillion as well. So no, I mean yes, there's been a rush in this space, but there's it's very scalable and there's a lot of room to grow.
What about the risk? You think about cyclical risk over different asset classes. Where would you place this? Maybe even like financial crisis type stuff, credit risk type crises.
Yeah, so I think there's a common misconception out there. People are getting cyclical and systematic risk kind of mixed up. Yeah, I think like a lot of asset classes, there's cyclical risk. You know, companies' earnings can contract, and so yeah, there's a little bit of risk there that they're not able to pay their notes. But systematic risk, I would like to push back a little bit. I think there's actually very little systematic risk like '08 and '09. The main issues there were banks were over levered. They had asset liability mismatches. Asset managers that are doing private credit, they don't have these issues. I mean, yes, they can do 2x, but they're not significantly over levered like the banks were back then. And
Yeah.
then you just saw in 2023, there's some bank failures that happened then. So I think private credit kind of acted as a line of defense.
Kind of
from
save the day.
yeah, from that credit crunch.
Yeah. All right. So who is this right for? Certainly high net worth individuals. As we said, we have a $5 million asset minimum before we deploy these type of investments. People who want to have ample liquidity, meaning that you would never have to sell this. It can live in the portfolio as long as it needs to.
Right.
And obviously understand that privates are long-term investments. So, I think that's important. Probably not talking to our entire client base with this. I think it's always important to learn more about this.
Right.
But the reason why you don't have access to it, if you have less than 5 million, in our opinion, is if you ever have to liquidate in an inappropriate time for the fund, you could really get hurt.
Right.
So it's much better just to be in like short-term treasuries and the aggregate
Mhm.
things of like normal investments. But anyway, thanks for listening to the episode. Thank you, Andrew, for bringing this and talking about this as a subject expert. If you'd like to learn more about Wiser Wealth Management or want to schedule a consultation, meet with one of our fiduciary financial advisors, you can do so by going to wiserinvestor.com. Don't forget, you can watch this on YouTube on A Wiser Retirement. And we also have in our show notes videos and other episodes you might be interested in. Thanks for watching. We'll see you guys again next week.